Hi everyone, welcome back to Lab for Crypto. Today we're going to deep dive in our bottom range model using logarithmic regression. The purpose of this model is to identify the best time that someone can accumulate an asset. There is a famous quote which says that money are made when you buy, not when you sell. Therefore, we think that this model is important for you to consider. In this video, I'm going to assume that you have never seen regression analysis before in your life. Therefore, I'm going to show you an example, a really quick example with very little maths about how regression analysis works, because it will give you a deeper understanding on the bottom range model estimation. And then I'm going to show you an example on how you can use this model and improve your portfolio performance. Before we deep dive in the bottom range model, a quick disclaimer that nothing in this video is a financial advice. It's just me explaining you how this model works and how you can optimize your portfolio performance, but always tailor your portfolio based on your risk tolerance. In the graph in front of us, on the x-axis is the date time, and on the y-axis is the price of the asset that we're looking in USA in dollars. Note that in our platform you can check more assets other than Bitcoin, so I will leave that to you to explore. When you mouse over on the graph, you will see that the blue color is showing the Bitcoin closing price, and the other three lines are the model lines, which I'm going to hide for now because first I want us to understand what we are trying to achieve, and then we're going to move to the explanation of the model. By just observing the Bitcoin price action, let's clarify what we want from this model. Bitcoin price on December 2017 was around 19K, and then it dropped to the 3K region in December 2018. And we want that model to tell us that this region was a great opportunity for you to accumulate Bitcoin, as it went all the way up to the 67K region in November 2021. And roughly that is a 22x gain, which I know, not too shabby. Moving to the current cycle now, we want the model to tell us, is the Bitcoin bottom in? When Bitcoin dropped from the 67K in November 2021 to the 15K region in November 2022, actually that was the bottom. And if not, and the bottom will come in 2024 because of macroeconomic conditions or whatever, at which price range we should expect Bitcoin to drop and take advantage of this opportunity if occurs. Before I move into the details of the creation of this model, I would like to show you a sneak peek about the performance of this model and define the three lines. The red line is the actual Bitcoin bottom value that we predict, and the green and the yellow line is our uncertainty level, which I will explain what exactly this level is in a bit. If we zoom now in the last couple of months, we will see that Bitcoin dropped from, as we said before, from the 67K, and it went all the way down to the 15.7K region. And the Bitcoin bottom value was predicted to be 15.535, so it was really close. And we will see that the Bitcoin price was actually bouncing on this line for almost a month, and the model was signaling that was a good time for you to buy. And the reason that I'm showing you this is because this model is something that we have published in our social media, and this is a post from Instagram that you can go and check, that on the 7th of January we have published the model, and a couple of days later you will see that the Bitcoin price bounced on it, and we wanted to show you this in case that you will say, okay, you are showing me this after the Bitcoin bottom came, but but this is not true, as we have publish this on our social media and you can go and check it at any time. The regression analysis example that we have prepared for you is a linear regression one. The reason that we chose a linear regression is because it's considered to be the easiest for someone new to the field of regression analysis to understand, and I will try to do my best to explain that to you. In the x-axis of the graph in front of us is the days, and on the y-axis is the car production of an imaginary company. The blue dots represent the number of the cars that this company makes per day. For example, on day 3, they manufacture 12 cars, on day 5 was 22, on day 8 was 30. And imagine now that the CFO of the company comes to the data science department and requests a model which will predict how many cars this company is going to produce in 30 days time from now. And using the data, definitely the data science team can create a model which can project how many cars this company is going to produce in the future. For the sake of this example, we are going to predict how many cars this company is going to manufacture on day 25. As you can see from the blue dots, the data that we have is only up until day 24. Therefore, our model does not have any information for day 25, and our job is to find that number. The model that seems to predict best the increase in the car production of this company is a linear regression model. This red line now is our model, and the equation that describes this red line is the following: y equals alpha x plus b. Alpha is the slope of this red line, and beta is where this red line intersects with the y-axis. And if we want to find the number of the cars that this company is going to make on day 25 is 83.2. And how this number now is calculated. The calculation of this number is based on the equation y equals alpha x plus b, where alpha is the 3.29, x will be the number 25, which is the day of our interest, and b is 0.88. And just a clarification, because I'm Greek, alpha is A and beta is B. That's why I'm using them sometimes interchangeably. So, if we want to predict even the day 26, 27, 28, what we have to do is just use the constants A and B, and on the x value, just plug in the day of our interest. The number of the cars that our model predicted was 83.20, and as cars are measuring units, we're going to round down and say that our prediction is 83 cars. And for us to gauge if our prediction is basically correct, we need to know what was the actual value that the factory was able to manufacture on day 25. And by clicking the next car production value, the value is 84. So our model managed to do an amazing job in predicting the next value with just a one car deviation. And now we're going to speak about the uncertainty part and how important it is when you create a model. As you might already observe, many of the dots are above the red line and many of them are below. And of course, there are some which are exactly on top of the red line, which that is perfect for us. But for these dots that are now above and below, we will introduce our uncertainty level. When you create a model, because you cannot be 100% sure, you will see that on the alpha parameter and beta, we have a plus and minus symbol on each of the parameters. And if we want to create now a new line with only the plus symbol, so the new equation is going to be y equals 3.29 plus 0.14 plus 0.88 plus 2.12, this dotted green line, which is called car production feed plus one standard deviation, is the upper bound of our prediction. And with the same idea, if we go to these parameters and subtract the 0.14 from the 3.29 and subtract the 2.12 from the 0.88, we'll create the bottom line, the bottom dotted line, which is the minus one standard deviation. Immediately, what you might already observe, we have created a channel. We have created a range which we call an uncertainty range. When we are making the prediction at any day, and let's take for example the day 25, we are saying that we estimate that the number of the cars that is going to be manufactured is 83.2, but the lower value that we expect is 77.5, and the upper value is 88.8. And in short, the idea of this uncertainty range is because we don't know exactly what the value of the cars will be, but we are giving an uncertainty level to give us better prediction as possible. And using this example now, you will be able to understand the regression models that we have in our platform, which they are the Bitcoin bottom range, the the total crypto market cap, the DeFi market cap, the fair values, and we have, I think, more than 6 or 7 models, which by understanding this model, you will be able to get a better understanding of the models that we have in our platform and be able to also understand more complex equations, which is exactly the same idea and the same principle. But instead of using this equation, which is considered an easy one, you will be able to see some exponential functions, some logarithmic ones, some polynomials, and so on. But the idea is exactly the same. After the example we just saw on the regression analysis, we can move to the Bitcoin bottom range estimation, and hopefully we'll be able to get a better understanding of it. Before we explain the model, let's hide the model lines and we will bring them back one by one and explain them. In the graph in front of us, we have the Bitcoin price on the y-axis in USA dollars, and the y-axis is in a logarithmic scale, and on the x-axis we have the date. By just observing the Bitcoin price, we can see that Bitcoin tends to have these explosive rallies and then retraces to a lower value, then establish this lower value as a support and rallies again to a higher value. Our goal is to identify these bottom values, as it seems that was an amazing opportunity for someone to accumulate. And by clicking this bottom points button, we can visualize better this bottom points region. Note that the selection of the start and the end of the selection of each bottom region is strictly selected by the creator of the model, as there is no mathematical rule which it will define you what will be the start or the end of the points that you are going to select, but is strictly by the observation of the creator of the model. By hiding the price, we may be able to see the trend of this bottom range of Bitcoin, and it seems that it follows a logarithmic function. Bringing back the price, it's important to note that our last data point for training our model and creating the regression function is up until September 2020. So the goal of this model is to predict the next Bitcoin bottom, so we will know when is a good time for us to accumulate, and if Bitcoin retraces back to this bottom range, we will be able to accumulate and set our buy orders between these regions. Let's bring the model lines back and explore what the model predicted. When the FTX bankruptcy was announced in November, the market crashed as expected, and our model was signaling that the Bitcoin bottom should be at 15.53k, and of course we have our uncertainty, which is between the 12.2 and the 19.7. But the red line, which is our prediction, did an amazing job, and we can see that the price of Bitcoin was bouncing for over a month at the Bitcoin bottom feed and then moved to a higher price on the beginning of the year. Before I move to a numerical example and explain how you can use this model to optimize your portfolio performance with an imaginary $1,000 portfolio, and assuming that you want to allocate this amount using the Bitcoin bottom range, I would like to show you a really easy example on how you can use this model in the case of the Bitcoin spot ETF is not approved. The market is expecting that the Bitcoin spot ETF will be approved in January 2024 with 90% probability. But for the sake of this example, let's assume that the Bitcoin spot ETF is not approved, and just before the announcement, the Bitcoin price was hovering between 37 to 40k. Probably after the SEC announcement, the Bitcoin price will drop to a lower value. And using our Bitcoin bottom range model, we can predict that the Bitcoin bottom will be at 22.61k, but our uncertainty region is between the 17.76k to the 28.78. And now I would like to move to the numerical example, which I will address the question that probably you now have, which is I want to take advantage of this Bitcoin drop because I believe in it. And I have $1,000 and I want to allocate them with the best possible way to take advantage of this drop. Before we move to the exact allocation of the $1,000, we need to make a quick observation that it will aid us allocate this amount optimally. Bitcoin price in November 2021 was around 67k, and it dropped all the way down to the 15k region in November 2022. But as you might notice, the green line was able to act as a support for a couple of months, and then the price was able to pierce the green line and found support on the red line, which is our bottom estimation. Then Bitcoin from the 15k bounced all the way up to the 30k in April 2023, and then retraced again in August 2023 at around 26k. The green line acted as a support again, and then the Bitcoin price went all the way up to the 37k region that is now. So after this observation, we will be able to make our portfolio allocation with the best way possible, and I'm going to explain now. Let's have a closer look. As we don't know if the green line will be able to act as a support again, therefore it's not wise to set a large buy order around the red line. So a potential strategy is to set a $200 buy order around the green line of 28.78k, then double that amount on the red line and set a buy order of $400 around 22.6k, and the rest on the orange line. Using this strategy, you will be able to maximize your opportunity in case Bitcoin drop to the red or orange line, but still in the case that Bitcoin managed to bounce from the green line, you still be able to accumulate Bitcoin in a really good price. And I hope you like the example, and I'm gonna take you back to the platform to see the same model there. In our platform, you will be able to explore the bottom range model for multiple assets. If you enjoy the content, please like and subscribe, as this will boost the algorithm to show our content to more people and help them take informed decisions. Until next time, bye bye.